Hey, founders, Kirk Mitchie with Candor Advisors. We got a accidentally insightful or instructive question the other day. A potential seller was asking us whether an audit was necessary or an audit of his business would be done when he sold. And it's a really, really good question. It doesn't come up very often. So the answer is generally no. Now, there's a big old asterisk on that no. What typically will happen is that when you've negotiated a letter of intent that both sides have agreed to that outlines the basic valuation in terms of the transaction, you go into a period that's called exclusivity. And during that period of time, you can't talk to another potential buyer about the company, and the buyer has to dig in and do their due diligence on the company. Usually what leads that diligence is financial diligence, and that is where they're going through your financials, usually with an outside accounting firm, maybe even a specialist in this area, to validate what you and your advisor have asserted to them about the transferable economics of the business. That's usually not only the top line revenue, but that adjusted EBITDA number that you've given them, and they're paying a multiple of that. So they need to know that that's legitimate. And if everything goes well, then there are no adjustments to that and the transaction can move forward. That will feel like an audit. It's not actually an audit. You might, in advance of that, depending on the size and complexity of your business, invest in what would be called a sell-side quality of earnings report, where you anticipate what their due diligence is going to look like, pay an accounting firm, hopefully one that's familiar with the business, to go through and make sure that your EBITDA adjustments are correct, make sure that your financials are done in alignment with generally accepted accounting principles, and if they're not, create an exception report and a bridge to anything that would be different, and then include that with the information that you give to the buyer so that you've provided full disclosure. It'll make financial diligence go easier. Now, if you have your financials audited, then you are in a great position, because whether they hire, a small one-person shop to do financial diligence or they hire a Big Four accounting firm, once you've had an audit, there's certain standards that are done. So it doesn't mean that you won't get questions, but you're a little bit more bulletproof. But audits are expensive and they're time consuming. So the key thing is to work with your advisors to talk about what's most appropriate, what's most likely in your circumstances, and know whether you will go through something that feels like an audit or you actually need to get an audit done. Hey, if we can help with that or anything else, go to Candor-Advisors. Click on the Talk to Kirk button, drop me a note on what you'd like answered or how you think we might be able to help, and we'll get back to you right away. Oh, and there are 150 or so videos in the Insights section of the website. Feel free to peruse those. That's completely free. Thanks. Have a fantastic week.